On August 12, 2026, Nebius Group shares jumped 34.1% after the company reported second quarter revenue of $582.3 million, up 454% year-over-year, and above what analysts expected. That revenue beat was the main reason the stock surged, and it was reinforced by losses that came in much better than feared and an upbeat update on AI infrastructure demand. To understand why that mattered, you need to know what Nebius actually does. It's an AI infrastructure company, sometimes called a neocloud. It builds massive data centers full of NVIDIA GPUs and rents that computing power out to AI companies. The entire bull case for the stock is that demand for AI computing is exploding, and Nebius is one of the few companies with the capital and the chip supply to meet it. That case had already been through a brutal test in the weeks before the report. The stock peaked at $286.69 on June 18th, then fell 48.3% to a low of $148.22 on July 29th. The initial trigger was a Bloomberg report that Meta was planning to sell access to its own excess AI compute. If Meta becomes a seller of compute rather than a buyer, that adds new supply to the market. More supply means lower prices, and lower prices mean less future revenue for a company like Nebius that charges for compute. The sell-off was also part of a broader repricing of AI infrastructure stocks over credit and funding concerns, not just a Nebius-specific problem. But the tape had started to turn before earnings. On July 21st, NVIDIA disclosed in an SEC filing that it owned a 9.3% stake in Nebius, on top of an earlier $2 billion investment. That's a huge signal. NVIDIA is the company that makes the chips Nebius runs on, and if it's willing to own nearly a tenth of Nebius, it's effectively vouching for the business. The stock jumped 18.8%. 9 days later, a new compute rack called Vera Rubin went live in Nebius's Finland data center, and the company announced a compute deal with Reflection AI worth more than $1 billion running through 2029. Shares rose another 27.1%. So heading into the August 12th report, expectations were high, but the stock was still about 10% below its June peak, leaving room for a strong print to push it higher. The report itself came out before the market opened on August 12th. Revenue was $582.3 million, up 454% year-over-year, and above analyst expectations. Losses were also much better than expected, and the company gave an upbeat update on AI infrastructure demand and capacity expansion. The same business that landed a multi-billion-dollar deal with Microsoft in September 2025, a deal worth more than Nebius's entire market value at the time. The market responded emphatically. Nebius closed at $259.20, up 34.1% on the day. That was the largest single-day move in the window under review, other than the September 2025 spike after the Microsoft deal. Combined with the 27.1% jump on July 30th, the stock had rallied more than 70% in under 2 weeks, recovering most of the ground lost in the July drawdown. Why did a revenue beat move the stock this much? Because analyst estimates are the market's best guess at what a company will earn, and the stock price already reflects that guess. When a company blows past the estimate, it means the actual business is doing much better than the market assumed. Investors who are waiting on the sidelines decide the stock is worth more than they thought, and they buy. The beat here was enormous, revenue up 454% year-over-year, so the repricing was enormous too. Reuters and MarketBeat both identified the revenue beat as the primary driver of the session's surge. The better-than-expected losses mattered for a different reason. Nebius is in the middle of an expensive build-out. Data centers full of the most advanced chips don't come cheap. The fear hanging over the stock was that this growth would destroy profitability, that every dollar of revenue would require $2 of spending. The report showed losses were much smaller than analysts had braced for. That tells investors the company can scale without bleeding cash as fast as feared, which makes the whole growth story more credible. The third piece was the forward-looking update. The company said demand for AI infrastructure remains strong and it's expanding capacity. That matters because Nebius's revenue today is a function of how much computing power it has deployed and how much customers are willing to pay for it. An upbeat demand outlook suggests the revenue growth isn't a one-quarter fluke, it's a runway. This was consistent with the Vera Rubin rack going live in Finland and the Reflection AI deal announced in July, both of which showed the company converting demand into actual contracts. As of August 17th, the stock closed at $268.85, up 300% from where it started the window a year earlier, and just a few dollars below its June peak. It has fully recovered from the July drawdown. What's still unresolved is the durability of the move, the specific guidance for the coming quarters. The company's own forecast of what it expects to make is still unknown, and so is whether the post-earnings level is sustainable. The threat from Meta's potential cloud business, the thing that triggered the July sell-off, hasn't been definitively resolved either. The stock's valuation now embeds the expectation that the AI compute build-out will keep paying off. Whether that's justified will depend on the next few quarters of actual demand.